Hey, what is up everyone? It's David here. One of the more commonly asked questions is, when should we sell? And instead of me answering it, I'm going to let Peter Lynch and also Warren Buffett answer that question. And then I'm going to react to some of the things that they've said. As usual, this video is no financial advice or recommendation to do anything. It's just general information for entertainment purposes.
My question is, what criteria do you use to sell stock? I kind of understand how you buy it, but I'm not sure how you sell.
Yeah. Well, the best thing to do is buy a stock that you don't ever want to sell. I mean, that's what we're trying to do. And that's true when we buy an entire business. I mean, we've bought all of Geico, or we bought all of See's Candy, or the Buffalo News. We're not buying those to resell. I mean, what we're trying to do is buy a business that we will be happy with if we own it the rest of our lives, and we expect to with those.
I think the whole principle of looking for a great business and buying and holding it for the rest of our lives is super underappreciated currently, just because of all of the hot stocks flying everywhere. And I'm guilty of that as well, because sometimes it does catch my attention and I want to know if that is indeed a good business. Honestly, I would love to talk to you more about that, especially around the businesses that are so good that we could hold for the rest of our lives and potentially even pass it to the next generation.
It's the same principle applies to marketable securities. You get extra options with marketable securities. You can add to holdings, obviously easier. We can never own more than 100% of a business, but if we own 2% of a business and we like it at a given price, we can add and have 4 or 5%. So that's an advantage. Sometimes if we need money to move to another sector, like we did last year, we will trim from some holdings, but that doesn't mean we're negative on those businesses at all. I mean, we think they're wonderful businesses, or we wouldn't own them.
Now, I just want to point out here that, remember, Warren Buffett has a massive fund. When he's talking about trimming holdings and having liquidity to add into a sector, they're talking about millions or billions of dollars. For me, instead of trimming my holdings to add into a certain sector, what I tend to do is just to deposit a certain amount into my portfolio every single month so that I have liquidity ongoingly to add into different sectors, if that's something that I want to do.
We would sell, if we needed money for other things. The Geico stock that I bought in 1951, I sold in 1952. It was, went on to be worth 100 or more times, before the 1976 problems, 100 or more times what I'd paid. But I didn't have the money to do something else. So you sell if you need money for something else. You may sell if you believe that valuations between different kinds of markets are somewhat out of whack.
So for me personally, if I need money for something else, selling my positions hopefully would be one of the last options I explore. I never ever want to interrupt the compounding effects of having those positions. With the other point Warren Buffett is making on selling your positions because you think the valuations are out of whack between different markets, that's essentially timing the market. And for me, I understand that it's incredibly difficult to do, and I try to avoid that as much as I possibly can. But we also have to remember that Warren Buffett and Charlie Munger are professional money managers. So they have the resources, the analysts, and the know-how to understand how to navigate around the market cycles. But whereas for me, I'm a retail investor, so I have the long time horizon to see things through. So I try to minimize that as much as I possibly can.
And we have done a little trimming last year in that matter, but that could well be a mistake. I mean, the real thing to do with a great business is just hang on for dear life. Charlie?
Yes, but the sales that do happen, the ideal way is when you found something you like immensely better. Isn't that obvious? That's the ideal way to sell.
Yes, Charlie, that is definitely an option. I think a lot of us just don't think of that being an option that we have. If I find something that I really like and it's much better than something I'm holding in my portfolio, then, well, I'm going to consider swapping them.
And incidentally, the ideal purchase is to have something that you already like be selling at a price where you feel like buying more of it. I mean, we probably should have done more of that in the past in some situations. But that's the beauty of marketable securities. You really do, if you're in a wonderful business, you do get a chance periodically maybe to double up in it or something of the sort. If the stock market were to sell a lot cheaper than it is now, we would probably be buying more of the businesses that we already own. They would certainly be the first ones that we would think about. They're the businesses we like the best.
I think this is one of the main reasons why it's important to do a lot of due diligence upfront so that you can find out whether this is a company you like, whether that's something that you want to own for over the long term. But the idea of buying and holding something for the rest of my life is a loosely held belief for me, because in a decade, a lot can change. And if for whatever reason, the business hasn't evolved, the economics hasn't gotten better, and it has deteriorated, then I'm not going to keep holding it in my portfolio. Now, the next snippet in this video is Peter Lynch's answer to when we should sell.
When you were actively managing money, you presumably were under the same pressures as other fund managers to show performance results. Right. Did that incline you to sell too quickly sometimes?
Well, I think my greatest mistakes are, it's funny, in a stock, all you can lose is 100%. I've done that. But your great mistakes is selling a good company, and then it doubles, then it triples and quadruples, because you make a lot of mistakes, and so those ones that go up tenfold, I call them the 10 baggers.
I definitely think that we can all relate to the idea of selling too early. Talk to me in the comment section below. What company did you sell too early, and what was the percentage gain you missed after that period you sold? Interestingly for me, it's a gold mining company that I invested in back in 2016, 2017 at around $3, and I tried to trade the company, and of course I eventually got out and made a loss. But if you look at the price chart now, yeah, I sold way too early.
Some of my mistakes just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my two greatest mistakes I ever made.
I think it's important to remember that we all have very different circumstances. So it could be selling too early for one person, but it could be exactly the right time for someone else. I personally think of whether I'm selling too early based on my circumstances. Now, at the time with the gold mining company, I was too naive to know what investing actually means. I wouldn't necessarily say that I understood what I did. But now I think more about my circumstances and whether I actually need the money. If I don't need the money, then, well, I'm just going to keep it there.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying if it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. You say, still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
So when it comes to documenting the 10-year, 20-year story of the company I'm invested in, that's something that I have to do a better job in. Because right now, I do my due diligence that takes into account quantitative and qualitative research. But a lot of the observations on what's going to happen in 10 years, 20 years time, a lot of it is on top of my head and I'm not documenting them. So what I'm trying to work on now is to document what I think will happen to this company in 10 years time and put that in writing just so that in the future I can come back to it and look at the assumptions that I made and see which of those I got right and which of those I got wrong.
Well, your modesty actually makes an important point, which is people with the best batting averages in the world don't bat 1,000. I sometimes get angry mail, particularly during bear markets, saying so-and-so recommended such and such and it went down. Well, how often did you come up with a clinker?
Well, this is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple, it offsets all those times you lose 20 or 30%. So when you buy a stock, you ought to say to yourself, how much can I lose and how much can I make? And you ought to be able to make a lot. Because stocks are risky. I mean, look at how much we lost in AT&T. Look how much we lost in Xerox. These were quality companies. You know, you can lose a lot in a stock. So you got to say to yourself, how much can I make? Because I want to buy a stock, if I'm right, I'm going to make a double or triple.
I think we can all do a better job when it comes to calculating the expected values or how much we can make of this position in the future. Not to mention how much we can lose in that position as well. So I'm hoping that in some of my future videos, I will make a lot of that due diligence process easier so that we can all learn and all get better as a retail investor. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.